So if you guys don't know me, I'm Julian Peterson with Old Capital Lending, and I am located in the worst place around in San Diego. Our company really got started 36 years ago in the great state of Texas. So I'm a loan officer, been with Old Capital for 3 years, but I have been investing for many, many years, and we'll go through that. But let's all really know that this past year had so many changes. And I'm here to talk about commercial lending. I'm going to talk about how to build your business and also what kind of commercial lending is available out there. But this last year, lots of changes, lots of changes. We ate out a lot. There was nothing that was certain, but we do know that there were a lot of people that have a lot of money that are now shifting from single family and getting into multifamily. And they're shifting their capital out of countries like Japan and China and Germany. These people have returns that are negative. So just imagine that, putting your money in the bank and the returns are negative. You're paying for them to put your money in. So what we're seeing is a huge impact on the multifamily, because this is a pretty cool investment segment to be getting into. So today I'm going to talk a little bit about Old Capital. We're going to talk about building your strategy and your team. And then we're going to go into the finer details of how to finance your next transaction in multifamily. So this is a little bit about us, kind of just looking at it. We do 85% of our business is in multifamily, and then the rest of it are broken out by the different commercial asset classes. Office has taken a huge hit. Industrial is one of the top, along with multifamily. Storage is another as Stacy knows very well. The senior and student housing has really been hit, along with retail. So anyway, this is Old Capital. We've been around for plus 31 years. We do $1 billion in loans. That is brought up between bank financing, broken up to agency financing, bridge, and CMBS. We closed 5,800 loans so far, and we only have 11 people with us. So we're pretty strong group here. I've been in real estate for 30 years. My first transaction was in Southern California, and I've had ups and I've had downs. So while you're involved in it and you may be having a great time, be aware that you could be hit with some losses, but it is just part of, the cyclical turns that we have in real estate. We're all about educating, and we do the Old Capital podcast. As we've got 4.2 million listens so far. We really want to talk to real live investors. So if you have not heard of Old Capital podcast, I highly recommend it. We also do our Old Capital Conference. We had our 4th one this year. You can see some really good keynote speakers. This year's was Keep Multifamily Great, which is really kind of a funny thing on words. So what I want to get into right now is build your strategy, build your team, and not the other way around, because what we see is a lot of excited investors coming into the market, as I mentioned, and they want to get right away close. You see on LinkedIn, I want to close 1,000 units this year, but they're not educated. So we really feel like there's the education piece, and what, REI USA, I mean, this is excellent. But in also getting educated, you need to figure out, we call it a 4-step funnel. And you need to figure out what your business strategy is, your market selection, building your team with all the relationships, and then at that point, figuring out where you're going to go with that property search and the criteria that is necessary. So let's break these down. Again, this should be something that you look at before you go and jump into a property. The business strategy, you really want to understand and identify a certain area. You know, you would not build a financial house without putting in your blueprints, right? You need to have things in order. So I get phone calls all the time asking about financing. And many times I say, well, what are your financial goals? What are you trying to achieve? Are you going to be holding this asset for 5 years? Is it going to be a legacy asset for 10 years? And a lot of them, they say, you know, I'm not really sure. And so this is kind of the reason why we bring up building your strategy first. You're just trying to figure out, what do I want to accomplish with this property? Are you going to do a rehab component? Are you going to do the rehab and then sell? And how much are you going to be putting into this property? Are you bringing 10% of the loan amount down from your group? And what is your strategy? Is your exit strategy going to be to actually get your investors out, but you actually hold this asset in perpetuity for years and years and years, and then you take the cash flow? So these are some really great things to think about before you jump in. And you know, these are illiquid assets that we're talking about here. So it's not like you can just put your money in and next year you can have it out. It does take in multifamily quite some time to change your capital. So there's another thing that you need to be figuring out, like, in your investors, who are your investors and what do they want? So not only what you want, but really surveying your investors. Like, I was in a deal, crazy story, where these guys were doing fix and flips in houses, and that's great, and I think there's a lot of energy and excitement. I was doing that at one time, and there's this burst of energy that you get and you hold on to it and you're ready and you move on. Well, they said, let's do this in multifamily. And their investors said, you know what, we're not willing to hold this. You know, they were used to having 18 months. And then they were asking, well, on the multifamily, guys said, we're going to hold this for 5 years. And so they said, we are out of here. When we got into investing with you, we thought it was only going to be 18 months like you did in the houses. So you really have to understand what your capital stack is and who's bringing the cash to the investment and how long they want to be in that. Really, really important. The second piece of this funnel is the market selection. Now, many times we'll talk to you about, well, how about your immediate area where you live? That's always a good thing. However, if you live in San Diego like I do, it doesn't make sense. We cannot get the returns here in this market, as well as let's say in the Bay Area, or let's say in New York right now with all of the changes that have gone on with COVID. You really do want to know your market. So we say, look at the investment success that is happening in those markets. How long are you going to employ your money? Is it a durable stream of income that you're going to be getting in return? Is it that you have to hold on to your cash for 3 years, or are you going to have to, or rather, and are you going to have to wait for year 6 to get the money out? These are really important questions. Now, if you don't go to your immediate area, really looking outside of it, and you really kind of have to figure out what market is going to be returning your capital as quick as it is for your strategy. You want to look at population growth. You want to look at income growth. You want to look at hospitals, and you want to be looking at schools. All of these details are super important to figuring out your market selection. I also talk about having people involved outside of your small network of friends and family, where you can really build the network in other areas. So how do you do that? Well, COVID has really created some great opportunities in Zoom. We would never be able to have built great relationships in other parts of the country except for going to conferences. So COVID, the great thing about COVID is really opened up the United States to go to other markets and become familiar with the people that are doing the business in those markets. I talk on a lot of Zoom calls, and not in just my market, but I'm going to Florida, I'm looking in Georgia, and I'm looking at New York and the Carolinas. And now I don't have to spend $5,000 and a weekend away from my family when I can really build those relationships within this, this Zoom community. So it's pretty cool. And then, as I mentioned, these are the data that you need to understand when you're looking at that and those markets. These are just a couple of them. I know that Neil Bawa does a great job. If you have any interest in learning more about how to do the market selection, I would recommend talking to Neil Bawa. He does a boot camp in it. Well worth it. The third part of this funnel is building your team. And as many of you have heard in multifamily, it's your net worth is your net work. They go together. So if you have a very strong network of people, you can get this done fairly quickly. And as Stacy had mentioned, you can spend thousands of dollars getting educated. And I recommend that, spending money, but it's also that network of people that you don't have to spend to get into your network. It's simply spending time with them. You're going to want to know, you're going to need in multifamily, you're going to need a sponsor, someone who has net worth, liquidity, and experience. And we're going to talk about that as we go into financing. But you're going to need a lender that you know, like, and trust. You're going to need a property management company, hopefully somebody that in that area where you're looking for a market, you can make a great connection. We recommend getting 3 local property managers. Now, there are property managers that are available that are nationwide, which is also can be advantageous, because if you have different markets, they'll come along with you, which is pretty cool. You'll need a multifamily real estate attorney, because we're going to be having SEC guidelines that we need to make sure that we're following. And of course, you're going to need investors. The last part of this funnel, again, these are the things that need to be put in place before going and looking at properties, is being able to identify how many numbers of units do you want. Some people getting into multifamily will say, I want to start out small. And I get that. But when you go small, the whole purpose and where syndication model really excels is in these larger number of units. Because if you think about it, when you have 5 units and one person moves out, that is a great strain on that 5-unit building. But if you have a 80 or 100 unit building, one person moving out does not put a great strain on it. So we're able to really scale our business. Thinking about a property management fee on a 5-unit building is going to be 8% as opposed to 3%, 2.5% on a larger asset. And even simply further, you are looking at taxes on a small asset, especially like in a state where there are insurance claims, taxes. Those really will impact the viability of that asset on the smaller side. So you really do need to consider it. Now, you may be saying, I can't go that large. And that is why we talk about building your team, because while maybe you can only look at 5 units, there are people out there that will want to work with you because you may be a great underwriter, or maybe you have an excellent network of people that you'll be bringing in capital raising. You'll be able to capital raise for a property. You may be boots on the ground. That means maybe you're going to help find a property and you're going to keep your eyes on it. And you now become part of the team and you will get paid for it with equity. So it's pretty cool. Knowing where you are and the choosing this criteria, really needs to be solid, because you're going to be communicating with real estate brokers exactly what you need and what your investors want. So it's really important. So 4-unit buildings, are you going to do, or rather 5 or more is commercial, or are you going to go up to 100, 200? Again, it doesn't take much difference to manage a 5-unit building than it does 100. Yes, it's going to be more expensive, but a lot of property managers do a better job when they have more units. So we can talk a little bit about this. Make sure that when you're looking at these properties, what is the crime? It's a big deal. Some of the lenders that we work with, if they find out there was a murder on that property or there's crime in the area, it'll make it very difficult for you to get lending. And understand, what are the improvements? Maybe the pool needs to be redone. Maybe you can add a dog park. Maybe you can put some shading for cars. These are all added amenities that add to your net operating income, and people want. You are offering a great place to live. And if you can add some amenities, some great reasons why, you will make more money dollar for dollar in multifamily. So then your final step is to find the property. So you say, okay, so I know where I'm going. I know who my property manager is. I kind of like Julie, but how do we figure this out? So I want to talk to you about your next transaction or your first transaction. How do I get that done? I'm scratching my head. How do I do that? So we talked a little bit about the asset classes when we started. What Old Capital? Old Capital is a broker. We work with a number of different types of lending possibilities. We work with not recourse lending. Recourse is when you buy your home. Any home that you buy with a bank, a local bank, is recourse. And we'll talk a little bit about that. We also do non-recourse lending. And as you can look at the asset classes across the board here, you can see what kind of loans you can get. We do the CMBS, which is commercial mortgage-backed securities. These are available when the non-recourse Fannie and Freddie, when they don't really want to be in that area. CMBS is a great alternative. Somewhat of an advanced, we'll also see that kind of across the other uses like office, larger offices, retail, industrial. CMBS will get into those as well. Again, we spend a lot of time in multifamily. So today we're going to really spend how we would do it in multifamily. And really it's going to be bank, agency, bridge we'll talk about today. And of course, there's always the private money. And sometimes you can't get the asset as quickly as possible. And so some people will go to hard money in order to get the deal. So let's talk a little bit about recourse loans. I talked to you about saying on single family, it is going to be recourse. That's a bank, a community bank, a credit union in where the asset is. Now, what you're seeing in multifamily is a lot of people are crossing different areas. Again, I'm in California. I could buy a property in Texas. I could buy one in Georgia. You don't see that so much. A lot of people want to buy single families close by where they are. It'd be great if we could do multifamily, but they're crossing. So when we cross into areas where you don't live, bank lending, this commercial bank lending, becomes a little more challenging. So what we want to do is have a boots on the ground that will help the bank have some security that somebody is going to be looking at this asset. So we want to make sure if you're looking in away from your home, who's going to help you with that? And that needs to be communicated to your lender. They're also going to want to know on a bank position, who are the people that are living in that asset? What do they are, if they're in Texas, are they oil and gas? And is there any flexibility, or is there going to be some waves of good and bad business? In Houston, it got hit with a hurricane, and there, over the last 10 years, they've really diversified. But there was a lot of problems with going to Houston and buying assets, because if the oil and gas left, then the city would be closed down. So we're seeing a lot of these cities diversifying so that more people will be drawn to them. The thing about bank lending, and I always kind of do this silly example, but it's kind of like the bank puts their hand and takes your wallet and puts it in their pocket and says, thanks, that's my portion of your balance sheet now. I have it, and I'm not giving it back to you until you pay me off. So it really eliminates, or it closes down your opportunities for being able to buy an asset, a multifamily property, Monday, Tuesday, Wednesday, Thursday, Friday, because it closes down your balance sheet. So if you've got $1 million in a balance sheet and you put on 900 with recourse lending, you're not going to be able to necessarily buy another property. So you have to be aware of that with bank financing. Typically, they're shorter loans. We see typically a 5-year loan, and the amortization is shorter. So on bank lending, you're looking at 15 to 25 years of amortization. So how does that affect the payment? When you have a 5-year loan, you're going to be paying 75% loan to value over a 5-year period, and it's amortized over 25 years. So your rate is going to be a little bit higher at, let's say, 4.5%, 5%, and the payment's going to be larger because you have shorter time to pay for it. Now, these are balloon payments. When we talk about commercial mortgages, they're balloon payments. So at 5 years after this loan, what's going to happen? Are the interest rates going to be high? Are they going to be steady and flat, or are they going to drop? So you're not sure what your business plan is. You have to be concerned about the financing. Bankers, lenders are your biggest partner. We're bringing 70 to 85% of the loan to you. So we kind of have the stamp of approval. We get to see your underwriting, but we're the ones that say, no, we're not going to give you 80% what you've underwritten, but rather, because of the performance of the asset, we're only going to give you 70%. So it's really important to have a very good relationship with a broker, because we can go to all different options for financing. So that's a little bit about bank financing. It is a good option for new people, and it's also a good option if you want something where you're not going to be holding it very long. Maybe you're going to be doing a short term, you're going to flip it over in 3 years. Bank financing can be a great strategy. It just depends on what you're looking to do. Again, this is recourse. It's based on your personal credit. If you have a bankruptcy, some people won't be allowed to get a bank loan. So again, when you consult with a broker like myself, we can talk about those different options for you. The second option is agency debt. And so this is something I thought was kind of neat to kind of have you understand, that in order to get this great type of financing, I call it the gold standard. Years ago in multifamily, the only people that were buying these buildings were your oil and gas people that had tons and tons of money, and they're going to the bank and getting loans. Well, that kind of changed over in 2008, 2010, and the syndication model came up, where we are pooling our money. We've got tons of people wanting to buy a multifamily property. And you say, well, why do they want to do that? Because there are advantages, there are tax advantages to investing in a multifamily property. You can get tax-free income when it is refied. You can get on a bonus depreciation, meaning instead of depreciating that asset over 27 and a half years, we depreciate it quicker. So in that first year, you, in essence, can take the loss of that building as your own because you're a small investor in it. So multifamily investing is really cool, especially so that the people that don't make millions and millions of dollars, like you and I, we can invest and take advantage of these incredible tax advantages. Now, if you think about, okay, but I'm getting 22% in the stock market. I don't want to move my money. You want to make sure you understand that in multifamily, this is a hard asset. You get tax advantages. You don't get tax advantages on stock market, nor do you get to know that it's going to fluctuate very little. It has huge fluctuations. So you might think about how you can utilize your money in multifamily using your IRA or your 401k. I won't go into that today, and maybe Stacy has had some people talking about that, but that might be an opportunity for you to come check out the multifamily. So there are 4 things that are important for this agency financing. And agency is, as I call it, the gold standard. This is what everybody wants. Why is that? Because we give you 30 years of amortization. So your payments are a little less compared to the bank. We'll give you 5 years, 7, 10, and even 12 years of financing. So your payments are smaller and they're longer. And that is so incredible because, you know, to go through some of these ups and downs in our cycle, you could potentially go through one whole cycle with one loan as opposed to 2 or 3 in a bank loan. So we're able to get you 70, 80, 85%. 85 would be on a bridge loan, but in this agency non-recourse lending option. So what's non-recourse? That is, it removes you from your balance sheet. So you could potentially buy something on Monday, Tuesday, Wednesday, Thursday, Friday, every day. It doesn't hit your buying power. It separates you from the asset itself. You are now an entity that has purchased this property. So it's very cool, but you have to have these 4 items, the guidelines. First is that asset needs to be 90% occupied for 90 days. So COVID hit and people are moving and we've got some evictions. So this has kind of been difficult for multifamily. And so over the last probably 4 or 5 months, we've seen some changes in these guidelines. And one of the things is what they'll allow you to do is have on Freddie Mac financing, they'll say an average of 90 days. So maybe one month is 95, the next month is 85, and the third month you're back up to 90. So always think about, I'm going to tell my broker that I'm looking for an asset that I want to underwrite, I want to maybe buy, that is 90% occupied for 90 days, and then allows you to utilize this type of financing. The other things that are important is net worth, liquidity, and experience. These things are critical to being able to get this type of loan. Let's break these down. Net worth. I may only have $1 million of net worth, but there may be people on your team that each have $1 million. Now you could potentially go out and buy a $4 million asset. Actually, you could go out and buy a $5.5 or $6 million asset because it's the loan amount is based on the net worth. So in net worth, it's net worth greater than the loan amount. So again, $4 million loan amount, you have $4 million in net worth. So you could go buy a larger asset, a sale price of $6 million, $5.5, something like that. Second piece is liquidity. So coming from the GP, which is your general partner, those are the people that are put the deal together. They need to have 10% of the loan amount. So going back to that $4 million loan amount, we're going to look for $400 in liquidity, $400,000 in liquidity. So I have 100 and all my friends have 100. That would be, you would be able to get this asset. Now, maybe you don't have any, and people talk about using other people's money, right? You've heard that, especially in multifamily. Some guy finds it. He goes through the funnel that we just spoke about, and then he finds this asset and he doesn't have any money. This is the networking piece where you go and find a sponsor, one person that could potentially help you take this down. He has net worth, liquidity, and this last piece is experience. So you don't have experience, you don't have any net worth, you don't have any liquidity, and you don't have experience, and you put this man or woman into your deal. What happened in October is Freddie said, we're not going to put ourselves out there, because this used to be Freddie small balance, which is 7 million and 7.5 million and below. They would say, if you live close by the asset, let's say 100 miles from the asset, you're going to have the net worth, you have the liquidity, but you don't have experience. I'm going to give you that loan. This is what they used to say. Until COVID hit, and this past October, they said, no more. We're going to actually require you to have 2 years of experience with 3 to 5 transactions. So now that fourth person, hopefully they also have the experience, and they are critical to the success of you getting the loan and this property. So in your networking, whether you're doing Zoom calls or you're doing conferences, you are on the search to find this sponsor. And I wouldn't say just one person or two, I'd say 3 or 4, because a sponsor is going to want to know where you're working, and he's going to want to, he may say, yeah, I'll go to Augusta, Georgia with you. I like that market. I have experience. But maybe he doesn't like that asset in the Georgia when you bring it to him in Augusta. So now you have to have another person. So you want to have a good amount of people on your team that can help you take these down. So let's review that again, because this is what really sets you apart financially using this type of tool. You need 90 and 90, net worth greater than the loan amount, 10% of liquidity, and that is separate from your down payment, and then your experience, 2 years, 3 to 5 transactions. That is the gold standard. Now, the other thing I want to tell you about this, which is different than the bank loans, is we will give you, believe this or not, especially if you're coming from single family, we're going to give you interest only on that loan. Seriously, we're going to give you interest only for 1, 2, or 3 years. And even potentially we could get it up higher than that if you come into with low leverage, something that's like 60% where you bring in 40. But this is a great strategy, and this is where a lot of the syndicators come to agency financing, because for 3 years on a 10-year loan, you're getting gobs and gobs of capital, and you're paying off your investors, and your investors are like, these guys are awesome. I'm always going to invest with these guys. And you do your rehab in those first 3 years, and maybe it is that you cash out your investors and they are paid all along. On that 4th year, now your principal and interest becomes a little bit larger. And so you got to kind of figure out, can I hold this? Do I want to hold this? Do I want to sell? And this interest only whole concept is pretty special when it comes to financing these larger buildings. Again, these are available at 5+ units. They start at $1 million in loan amount. The last thing I want to tell you is, in commercial lending, everything has a prepayment penalty of some sort. Banks, maybe they'll give you a step down, and I'll go through that. Sometimes they will give you a prepayment of 1% anytime during the loan period. In agency financing, which again is just so amazing to me, you've got two ways to get out of these loans. One is called yield maintenance, and the other one is a prepayment step down. So, and to make this very easy and understandable, and I can certainly take you through this when we sit down and talk, and I'm certainly available to everyone that wants to get more information about this, is we're, in California here, we have this restaurant called In-N-Out Burger, and you can go there and you can figure out all different kinds of ways to make your burger. You can have grilled onions, you can chop grilled onions. I mean, there's tons of different ways. That's kind of how the multifamily financing is as well. There are lots of different options. So you can say, I want yield maintenance. I want that prepayment penalty. And that is, by the way, the cheapest on a 10-year fixed, cheapest way to finance is yield maintenance. The other way is prepayment, step down prepayment. So let's stay with yield maintenance right now. When a lender goes to give you a loan, they're off selling your security, and they're telling their people that are wanting to get paid on your loan, we're going to pay you every month in today's market 3.5%. So every month the person goes in their mailbox and they get out their check, and it's at 3.5%. And I've given you this loan for 10 years. Well, let's say your business plan is completed after 6. You have 4 more years. Why? I don't want to hold on to this loan. I want to get out. So in today's market, we are in the lowest 10-year treasury ever, even below 1955. With that said, and we know that the Fed has said for the next 10 years, we're not raising rates. What would be your best option? In my mind, going with yield maintenance, knowing that the rates are only going to go up, your yield maintenance will be, as it goes up, I've told my investors I'm at 3.5. If it goes up, I don't have to make these people whole. But if the rate goes down, I have to make all of these people whole. And what we're seeing right now, and great opportunities are out there in multifamily as assumptions, because they bought, let's say 36 months ago, it was at 5%. They got into the cheapest yield maintenance loan at 5.5%, and it dropped. So all these investors, if we get out, we have to make them whole. We told them for 10 years, we're going to pay you. So what's happened is investors are saying, I want out, and I can't, because this is like $1 million to get out. So what they're saying is, I'm going to keep this loan on the property, but I'm going to sell it to someone as an assumption. Now, that's all part of the strategy. That's all part of the risk when we get into multifamily. Today, yield maintenance is not, in my mind, is not a risk, because we have a new president. We have vaccines coming out. We have unemployment dropping. We have the stimulus package. There's a lot of things that are saying potentially rates could go up over 5 years, depending on your strategy, right? Or even over 10 years. So I would say, yield maintenance might be a good option. But somebody out there might say, Julie, I really need to sleep at night. And so I say, okay, that's fine. Let's do a prepayment penalty. Let's look at how that would pan out for you. Now, I hope you guys are out there and you're taking notes, because this is critical. I'm going to jump off of here for just a second. What happens with, let's see, end my slideshow.
We see you. That's all we see. We see.
Okay, do you see me now?
Yeah.
Okay, cool. So let's talk about this for a second. So if you take a piece of paper and you put a line across it horizontally, on the left side, put 1, 2 across the top, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's the length of your loan. And that's how long you think you're going to be in it. And then below, you're going to take under the number 1, you're going to put 5. And under the 2, you're going to put 5. Under the 3, you're going to put 4. And under the 4, you're going to put 4. Do you see a pattern here? 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. That's what it will look like across. So in that example where these people needed to get out in 5 years and the rates went down, they had to figure it out. But prepayment penalty, you can do this. Let's say at 6 years. Stacy, you can answer this for us. At 6 years, because I know you wrote it down, how much is the prepayment penalty going to be at year 6?
I have no idea.
Okay,
How do we
so
figure
if you look across it under year 6, it's going to say 3.
Oh,
So,
yeah, I'm sorry, you meant the numbers. Okay, from
yeah, so it's going to
Okay.
cost, yeah. So it's going to cost you 3% to get out of that loan. It might only cost a percentage, a tiny percent on the yield maintenance if the rates go up.
Okay,
But
I get it.
yeah, on prepayment penalty, 3%. So you put that into your underwriting and that helps you sleep at night. So you'll have a 3% for prepayment penalty and you'll have probably a sales cost of 3% of some sort. So it gives you an opportunity to know exactly how to get out of that loan, when to get out, what it's going to cost you. It's pretty cool. So those are, again, very simple, but neat things that you really do need to understand when we're talking about agency debt. And again, we do tons of business in this. We love this for the syndication model where you're gathering people's money and utilizing this this product. Now, sometimes you say, I don't have 90 and 90, 90% occupied for 90 days. What is my option? So your one option could be to go with the bank financing. But there's this other product that is non-recourse, so you don't have that personal guarantee. It's called a bridge, kind of like a construction loan, but it's non-recourse. When we look at how a property performs in multifamily and we use agency debt, we're looking backwards. We're looking at the T12, we're looking at the T3, we're looking at the T6. That's how every month we're seeing how it performs. Multifamily in this asset class is very different than single family because single family up to 4 units looks at what did the neighbor next door sell that property for? Did they have purple paint like I have purple paint? In multifamily, it's all about a business plan. How much money is being generated through rents, through the those pet rents, those having the pool, all of those make up the business, how much money, and that's how we assess these assets in agency debt. When we look at the bridge, we're looking forward because we don't know what's going to happen in 3 years. So there's a little bit of a difference in how we underwrite these using bridge. So bridge is going to look forward. We're going to ask for your pro forma. Pro forma is how somebody sees in year 1, 2, and 3 how the asset is going to perform. If we're at 75, everybody's goal is to get it to the agency financing. So what is it going to take for me to move from 75 to 90% occupied? And if I find a distressed asset, maybe it hasn't been rehabbed. So how much money do I need to infuse in this property over the next 36 months? How much are the rents going to rise? And that really takes some work on the underwriting model as well as from a property management position, because ultimately they are the ones that are going to be responsible. A property manager is the one that is responsible for getting these things done, not you as so much as a syndicator, but we really rely on the property manager of the asset to provide for us. Can we get our business plan done in 3 years? Because these bridge loans are only 3 years. And guess what? They're only interest only as well. So again, money coming in, paying for rehab, paying your investors in a short amount of time. It's a pretty cool product, pretty cool generation of wealth. But you have to be very, very careful. A lot of times on these bridge loans, we're going to want to see somebody that lives close by the asset who has the experience. So once again, if you live in Phoenix and you're buying something in Augusta, get somebody on the ground as boots on the ground and a property manager in that area. It's very critical for the success of that property. All right, so I think that's all I had for what kind of products that we have. Let me see what else I can share with you. Do we have, nope, you don't have mine up. Here we go.
Okay, we see something.
I think you have it now, right?
Yeah, show me your screen.
There we go.
Okay.
I got you now, right? Okay, so we did the agency and the bridge. We're not going to go through CMBS, but I do have something for CMBS. It is, again, for something that doesn't need rehab. These are $50,000 as an application fee. It is ridiculous. Those other agency, it starts at 10,000. You got to have 10,000 to get it going. Bridge, I'm sorry, a bank, much smaller. They don't even have an application fee. So just depends on what kind of financing you want. This is kind of how we work, how the process works. You're going to call me before you put in an LOI. We're going to have a conversation because what you underwrite may look great and it's returning a lot of capital to your investors. But once we put on the loan, let's say you're modeling it at 80%, I can only get to 70. You're going to need to remodel that and see if the returns work for you. You would hate to get into a transaction where you have a PSA and now you can't return to your investors and you have to step away. Remember, all you have is your reputation in this industry and you don't want to make mistakes. So that's why I say call me first even before you put in the LOI and before the PSA is signed. So the steps that once we sign it in, let's say a Freddie loan, it locks that day for the loan rates. Fannie does not lock on the commercial side. It goes up and down until about 4 or 5 days before you close. So it's something to be aware of. And if there's a lot of need to be at a certain point, we would recommend using Freddie. And we won't go into all those details, but it's something to be concerned about because you do want to lock it as soon as possible. And then we get into third-party inspections. This takes about 3 weeks. Your lender checklist, after we've gotten the information, they want to get a little bit more information. We'll underwrite it. Takes another three weeks or so. We submit it for approval. And then we get the loan approval, again, maybe 4 days before we're going to close. We lock it and then we close. All of this time, it can be stressful. So you have to be really open to the process. We're going to be asking for your financials. We're going to be asking for any of your properties. We're going to be asking for your personal financial statements and your schedule of real estate. We're also going to need a resume from you. So, going back to the beginning of our conversation, that 4-step funnel should also have your paperwork ready to roll so that you're open to getting one of these types of loans. So what's next in commercial? Educate yourself, understand what it takes, the qualifications, start underwriting these deals, and then make offers, and then let's close some deals together. One of the things that I started about 18 months ago before COVID was Zoom at 8. This is a group of people that come. We get 85 to 100 people every Tuesday night. And we have a speaker. This happens to be Keith Weinhold, who does a lot of single and to 4 units. He's a real a real experienced educator, and we just had him last Tuesday. But these people that are doing the business, and sometimes we even have a little bit of fun. You can see this is the funny face group picture that we usually take every week. But I highly recommend, if it's not my Zoom at 8, you get into a Zoom call every week where you're meeting investors, people that will help you get what you want to get done. Are there any questions?
I do have a couple of questions.
Okay.
So go into just real fast, the difference between like what you offer is, I mean, what you're offering and syndication and funds, because we have a 506C Reg D fund.
Okay. Yeah.
Yeah. So kind of get into that so people have a little bit more understanding.
Well, so the fund is what you'd use for paying, bringing the down payment, right? We're going to want to have people that are in a deal. You're going to bring the fund to the deal. Who's going to be the sponsor? Who's going to be the underwriter? Who's going to be head of the property management, the asset manager? That's what we help put together. We'll bring a fund in, but we also need people that will be the boots on the ground and the people that will be the GP, general partner. So we help the general partner find funds, right? We'll go out and we'll search, hey, we need $5 million. So we'll call up Stacy and we'll say, hey, we've got a deal here. We're looking, my customers, my clients are looking for money. Would you guys like to invest in this?
Got it.
And then the fund comes in.
Okay.
Now the fund becomes part of the general partnership, which is pretty cool.
Okay, cool.
Yeah.
All right, good. That's awesome. I love it. Also I had another thing. How does that work? Like if you find a property, like if we find a multifamily that or some sort of property that needs work.
Yeah.
How does that work?
Well, a couple things. If it happens to be where you've got your net worth, liquidity, and experienced person, and it's below the 90 and 90, we can use that bridge.
Okay.
But if you don't have that person or those people, you need to make a decision. Do I want this asset enough? You can go to a bank and we can help you go to a bank, or you can do a hard money and quickly get it under your ownership. And then you can figure out, okay, which strategy do I want? Do I want to go to a bank or do I want to do bridge?
Mhm.
And the ultimate goal in multifamily is for longer term hold is to get it into an agency debt.
Okay, got it. And so, and then, so if somebody here comes across a property that they're like, okay, maybe this is something that I want to buy, the best thing I think is just to call and talk to you to see what deal they can work.
Absolutely.
Now, what's your minimum?
$1 million.
Okay.
And 5-unit building.
1 unit, 5 doors.
Yep.
Okay. Yeah, I mean, in Atlanta, somebody was posting out in like one of the like our Facebook group, and they were like, "We're looking for a $500,000 10-door unit," and I was like, "There is no such thing in Atlanta. Sorry."
Yeah, that's going to be a tough one. I mean,
what do you see like per door now?
Well, it depends on the market, right? I mean, I'm in Southern California. We're at $500 a door.
Oh my God.
I have seen as low as $37 a door,
Mhm.
and I've seen as much as $240 a door. So it just depends on where you're at.
Well, yeah, as I said, I think on average it's around 30. I mean, for us at least 35 plus.
Yeah. It's tough to get into those lower. And let's face it, ladies and gentlemen, the interest rates are so low right now. If you can get a deal that's in a B class area where you're not having to put a bunch of rehab into it and making it a C to a B minus, you could get a little bit better product in a class B and have way less time and energy in that. You know, you're paying the same amount for the capital and you're getting a better product. So you kind of have to think about what is my risk tolerance in this, because a C product is going to be a risk tolerance, because underneath the the ground could be a lot of problems,
Mhm.
and a lot of these C opportunities, you're in 3 years, because why? Because they're kind of like flips. They could explode. They could explode underneath the ground, and you don't want to be there. You want the next owner to
Mhm.
be in those transactions. So
So in the multifamily world, essentially, you guys talk A, B, C, D. In the
yeah.
storage facility world, I mean, we kind of sort of say that, but we say a lot. We do primary, secondary, and tertiary is what we do.
Yeah, well, we do the tertiary as well, and I didn't reach on that today, but tertiary is really becoming the place to be.
Thank you.
We're not in Atlanta, we're in Augusta. We're not in let's see, Birmingham. We're in a smaller market in Huntsville. I mean, this is where everybody's going. But in that, everybody's running there, so you better be in the head of the pack.
Yeah, yeah.
Jackson, Mississippi, not a lot of people are going there, and they have rents are increasing and could potentially be a great place to buy.
That's a great question to ask. Like, which markets are good for like nation? Because these
Yeah.
are all nationwide. Where should we be
Yes.
focusing on? Would you know any good markets? You said Mississippi?
Well, a lot of people are not going there yet, but I've done a little bit of trying to track it down, and it is the population growth is slowly, because we usually want to see it build over the 10 years. It's been a slow growth, but with COVID, I think it's going to continue to grow. We have increases of 3%. You can go to Phoenix, and rent increases are at 8%. So it just depends on how fast you want to move the needle.
Do you look at a lot of like do you look like at population growth? Because that's what I focus on.
Correct.
Population.
Yeah, population growth. Well, and rent growth, particularly those two, right?
Yes.
Job growth. Yeah, I mean,
Which
we
I
all
think
got,
in any industry you should be looking at that.
yeah. But you look at Austin. I mean, Austin is expensive, and now we're seeing Oracle go there. We're seeing Tesla go there. How much more is it going to continue to grow? I mean, the rates are just phenomenal there, but you can't buy anything. It's so expensive.
Yeah.
It's like here in California. I mean, I'm making $11.49 on a property that I own here a month. We just don't, but when I sell it, I'll make 400. But if you can go through as an appreciation, that's great. But that's not what most people do. You really look for cash flow.
Do you do anything with short-term rentals?
We don't.
Okay.
We don't do short term. The model is to help Americans have a place to live that's safe and clean, and we don't do short term. Banks would do that. Just single family kind of
One
thing.
more question is, does experience with a 4-unit building qualify as experience if you want to get into a larger complex?
If you had like 4 buildings or 5 or 10 buildings potentially, but it not really. It's kind of like saying I'm a limited partner. That's great and everything, but it doesn't really help when it comes
So you
to
should be like, if
financing.
you want to do multifamily, you should be focused. Like if you want to be in multifamily, you should like, okay, 5 doors or more.
Yeah.
Just like, that's like, I'm just going to start with 5 doors.
Yeah.
And then, because like, and honestly, that's true. I mean, I know a lot of people are like, I want a quad, but like essentially those are really considered like residential property.
Yeah, and they're certainly easier to get loans on them. I mean, that's awesome. But just the scalability of it, again, if one person moves out, it puts a lot of stress on the asset itself.
Well, and then like, if you want to play with the big boys, you better look at some 5+.
We don't call it the big boys. We call it the big girls.
Thank you. If you want to play with the big boys, I should have said that anyways. But anyway,
There are some big girls doing some big deals. So,
yes.
have faith. We can do this.
I believe.
We're badass.
Yes, we are. I believe that. Okay, awesome. Well, thank you so much for coming to hang out with us. This is a good overview of kind of how the whole process works. And we've had, I think, Monique talked about syndication. Peely, do you know Peely?
Okay. Oh yeah.
Talked about
She's big in it.
So I think, it's a good, from all 3 of you, it's a very good overview for people to kind of get the idea of how it works.
Yeah. Cool. Well, I'm certainly a resource to help if there's anybody in the house that needs understanding or help. I'm just a phone call away.
Awesome. Cool. Well, I appreciate it. And we'll talk soon. Okay.
Sounds great, Stacy. Thanks so
Okay,
much for the
take care.
opportunity. I do appreciate it.
Yeah, no problem. Take care.
All right, take care. Bye-bye.